Most traders look at a chart and assume candlestick patterns are the engine driving the market. The reality is much simpler. Price moves for exactly one reason: absolute imbalance. When aggressive selling is halted and violently rebounded, it means one side has completely overpowered the other. Major institutions don't achieve this level of control by watching standard lagging indicators. They do it by burying hundreds of thousands of hidden iceberg orders at specific readable price-ins, quietly absorbing panic and manufacturing momentum. We're going to map the specific order flow fingerprints institutions leave behind. This involves identifying retail traps before they spring and applying a strict three-tier sniper entry framework to find institutional alignment. When you recognize how absolute imbalance is actually engineered, you stop placing trades blindly against the market's heavy current, and you start taking entries directly alongside the institutions controlling it. The process starts by understanding order types. Retail traders typically operate out of urgency, using aggressive market orders fueled by FOMO or panic to hit whatever price is available. Institutions operate with patience. They use massive walls of passive limit orders, refusing to buy or sell a single tick beyond their chosen price. When retail market sells slam into institutional buy limits, price is violently compressed into a tight base. Iceberg algorithms constantly reload fresh buy limits, absorbing all momentum. Once exhausted, institutions cancel their limits, launching price skyward in an extended range candle. Because the price jumps so violently, it creates a zone with zero transactions between buyers and sellers. This is called a fair value gap, or FVG. That empty gap acts as a vacuum, pulling price back down later to fill the void. You can't see the exact moment an institution places an order, but you can see this sequence: a tight absorption base, a violent breakout, and a fresh gap left behind. That is the footprint. This diagram shows the strongest iteration of that footprint, the drop base rally, or DBR. It takes immense institutional capital to catch a falling market, absorb the full weight of the downward momentum, and reverse it into an aggressive climb. This sequence creates a highly defensible demand zone. To trade it, you need strict boundaries. Step 1. Place your entry trigger, the proximal line, across the highest wick inside the base cluster. Step 2. Draw the distal line at the absolute lowest wick of the entire formation. This is your stop loss. The exact mirror image is the rally base drop, or RBD. This is a top reversal supply zone. Instead of catching falling momentum, institutions cap a euphoric rally, quietly distribute their risk to greedy retail buyers, and then drop the floor out from under them. Both the drop base rally and the rally base drop share one critical trait: they require a complete change in intent from the market. The sheer capital required to halt and reverse a trend makes these two specific zones physical fortresses on the chart. Now that you know how to build the fortress, you need to recognize the trap. Continuation patterns like the rally base rally look identical to a reversal zone, but carry almost none of the required capital commitment. The trend is already moving upward, meaning institutions barely have to spend any money to push it higher. Looking at this chart, retail traders spot the mid-trend pause. They draw a box, place their buy limit orders, and lock in their risk by placing their stop losses directly underneath the continuation base. Institutions frequently use these textbook rally-base rally zones as an inducement, engineered baits specifically designed to get retail traders to cluster their liquidity in one highly vulnerable spot. Once the trap is loaded, the liquidity sweep executes. The price violently slices down straight through the continuation base. Every single retail stop loss is triggered. A triggered long stop loss is a market sell order. By sweeping that trap, institutions instantly generate a massive flood of selling pressure, which funnels directly into the true drop-base rally fortress they built at the very bottom. If you don't map out inducement zones before placing trades, you will inevitably become the liquidity fuel powering the institution's real move. To safely enter the market and achieve extreme risk-to-reward ratios, institutional traders nest their analysis across 3 distinct timeframes. Missing even one of these tiers means abandoning the trade entirely. Step 1 is setting the compass. This wide chart shows the daily timeframe. Here, you only map out the major reversal fortresses, the untouched demand and supply zones. If the current price is floating somewhere in the massive, unmarked no man's land between these zones, you do nothing. You wait. Step 2 confirms the intent. When price finally touches your daily macro zone, you drop into the 15-minute chart. You do not buy blindly. You watch for price to pierce a local low, seemingly confirming a downward breakout. This snapback signals a high probability shift in intent, suggesting the downward move was a manipulation sweep, and smart money is entering the market. When price violently snaps back up, it creates the change of character, or chalk. Step 3 is the trigger. The exact moment you see that change of character, you drill down into the 1-minute chart. You find the micro fair value gap left behind by that aggressive snapback, set your limit order there, and place an incredibly tight stop loss just below the manipulation sweep. Daily for the compass, 15-minute for the confirmation, 1 minute for the exact entry. That is the discipline. Read the absolute imbalance. Map out the high capital fortresses. Discard the continuation traps designed to induce retail, and wait patiently for all 3 tiers of execution to align. When you pair a 1-minute stop loss with the vast runway of a daily reversal zone, you ride the macro institutional wave. That asymmetry is what naturally produces risk-to-reward ratios of 1:5 or higher. Stop being the liquidity fuel. Look at your past trades. Are you catching reversals, or are you getting swept out in continuation traps? Drop a comment below and let me know